Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. It's good to be back after 2 days of market holiday, which I'm sure for JK was spent following up with the many data points that were released. The theme, which I could understand, was a stronger US economic data from retail to the industry side, while Fed minutes warning of another hike, given the fears of inflation rising again. On the other hand, China continues to struggle. It cut its medium term lending facility to 2.5% in a surprise move as its housing industry continues to slump. The rupee also traded close to its all time lows, breaking the 83 mark on Monday. Uh, and this is basically over to you, JK. Take us through the data that is released. What's your sense on China? Is the weakness in yuan, is it preventing RBI from curbing the rupee depreciation?
Good morning, Swaraj. Yes, a lot to digest since we were closed for 2 days, and we're seeing the impact of the several data points that have been on the release in the last 3 days. But what stands out to me is the mayhem on the bond street that's happening. The 10-year bond yields have moved up to 12 basis points this week and by 33 basis points this month, while 30-year has moved up by 10 basis this week and 37 this month. Now, the money flow is renewing into the US bonds, rather the USD, not the bonds. Bonds are not being bought, but the USD is being bought because people are selling bonds everywhere, and particularly the carry trades are being unwound. Just to give you a perspective, the central banks who are major holders of US bonds have been selling heavily as well. We have data that shows Saudi Arabia's stockpile of US Treasury has fallen by 41% since early 2020, the lowest level in 6 years. China has sold 11.3 billion of debt in June, bringing its total bond holdings to lowest level since 2009. So we are not only seeing US bond yields rising, but also in every other country almost, like in Canada and UK, for example. The yields are at 15-year high. In Germany, it is at 11-year high. And so bonds are being sold across. USD is gaining. So the bond market sell-off is actually resulting in a broader risk-off sentiment. Stocks lower, bonds lower, then commodities lower, and the dollar is higher. So that's what the scenario that is starkly visible right now. Although we have had several data points, the data points also added to the yields going higher in the US because we had the industrial production and retail sales all beating the expectations. Consumer inflation expectations are somewhat lower, but the housing market is doing much better also. So added reason. Then the Fed minutes, where most participants said inflation risk could require further interest rate hikes, could not have come at the worst time for the bond market. We also had the Fitch rating analysts warning about inching closer to some turbulence in the US banking system, and the sweeping rating downgrades of dozens of US banks that could include big banks like JP Morgan Chase. All these are not helping the bond market either. So we have vulnerability everywhere: stocks, financial institutions, and the banking sector. And we will not be surprised to see more stress in the banking sector in the US that can add to the risk of sentiment. Now, probably we are slowly and steadily moving into a bond market-led crisis. Now, amidst all this, China has captured a good chunk of the financial news headline in the last 48 hours. And then we had a medium-term lending rate facility cut by China, followed by weaker than expected July activity data of retail sales and industrial production in June. And then we also had evidence of monetary easing, that further easing that can be seen from China, leading to more weakness in the yuan. Data was accompanied by news that youth unemployment figures would no longer be published. And also Chinese authorities are considering cutting stamp duty on short trades for the first time in an attempt to revive confidence. There is also news that Chinese officials are telling big institutions not to sell shares. So there is a lot of crisis type of measures that is happening in China, and that's not aiding the overall atmosphere in the market. So the data from other countries, of course, Europe is still giving a mixed picture. Stability in industrial activity there, was a slight surprise, but the forward-looking surveys are still grim. UK economy is somewhat better holding up, though employment is starting to see some stress. The inflation has eased off, but still at a much higher level compared to other countries. Japan data has been generally positive, but Japanese exports have fallen for the first time in 29 months, as per data released today, and this is in keeping with the overall trend of global trade falling. Australia unemployment, again, a dire picture there. Unemployment rate rising to 3.7% from 3.5%. Now, in this atmosphere, you can't expect the risk assets to do well. Then global equities have lost about 2% this week, continuing their bear trend of this month. And the major markets have been down about 5% this month. Now, the dollar index itself has moved more than 0.5% higher this week, with low yielders like yen and yuan taking the bigger hit. Of course, the yuan has its own domestic issues, as already highlighted. The commodity currencies, due to ongoing China problems and the sense that global economy may be eventually moving towards a recessionary trend. In fact, looking at the trade figures that is announced by various countries, which are falling, sizable fall on a year-on-year basis, one gets a feeling that the global trade is already in recession. And it's just a matter that it spills over into other real economy, because then you have the manufacturing that's slowly getting hit. Manufacturing PMIs everywhere are down for last several months. We are starting to see the real impact of the higher interest rates, and also the fall in the global demand. The recession tendency is definitely starting. When the bond market spill over into the large economies falling, we cannot see the central banks ignoring it, and we should see some policy measures. Maybe not a rate cut, definitely, but perhaps a decision to stop the quantitative tightening, because you cannot have a situation where the central bank also continues to sell securities to reduce liquidity when there is an all-round sell-off in the treasuries, because that will only worsen the government's fiscal position and ability to raise money to meet their commitment. So all this is really something which is now leading to some sort of a climatic, risk aversion in the markets, and that should eventually lead to some sort of government or the central bank intervention to cool off the market. Otherwise, we really see things are really getting out of hand. Now, if you look at India, of course, you mentioned about Chinese yuan influencing the rupee. Yes, definitely it is. But if you look at the rupee level at 82.20, we are almost at the all-time highs. The benchmark is the level that we saw in September 2022, when the dollar index was at 114 plus. Today we are at less than 104. Dollar yuan was at 7.37, which is just about there, and the rupee is also almost at the level that was seen there. So rupee has not overreacted. Rupee has moved very, I would say, more orderly than perhaps the Chinese yuan and some of the commodity currencies, thanks to RBI's consistent selling on Monday. The breakout of 82.85 did not create a panic, and we didn't have a very orderly market, though post the normal market hours, we did see rupee rising to 83.15, and then later on in the offshore market, it traded as high as 83.40. But since then, we have seen the rupee stabilizing below 83.20. I think it will wait for more global cues, particularly from Chinese yuan, where, of course, we are seeing reports of the state-run banks selling the dollars continuously. On the data side in India, of course, inflation was a shocker at 7.44%. The highest estimate was even 6.9%, as I could guess. I could see before the data, and food inflation at 11.49% from 4.49% being the big culprit. Even the WPI, which has been in deflation for 4 months in a row, has now seen the prices jumping. And the food inflation there also rising to 7.75% positive from minus 1.24% in June. Trade data has been steadier. with the deficit almost as same as last month. But then again, in line with the global trend, Indian exports declined 16% on a year-on-year basis, and imports down 17% in a year-on-year basis. Now, India is not an exception to the global trade trends, so that is, some of a concern. Particularly, the exports falling would be a matter of concern for a large economy in India, where there is a huge amount of youth looking for employment, and this is something that policymakers will keep in mind, and perhaps keep even the rupee may not be strengthened if the global currencies are falling. I mean, all this, we had two rating agencies which have given positive statements on India, which should keep the statement sentiment somewhat positive. We had the Fitch, which has given a very good observation on Indian banks being in an operating environment that has strengthened as the economic risks associated with COVID have ended, and there is appropriate buffers built against the stress. The India's demography helps the banks to weather the global storms also. And S&P also projected Indian economy to grow by an average of 6.7% till March 2031, and driven by manufacturing and services exports, consumer demand, and despite the short-term challenges that we may be facing because of the global turbulence. They have retained growth at 6.6% for the current financial year. But even at this, India will be the fastest growing economy in the G20 space. So overall, expecting dollar strong environment, rupee perhaps not expected to weaken as much as other currencies, because we are already trading at the all-time highs. Yes, break of 83.30 can bring in some more stop losses, but I think any fall would be moderated because of the efforts of the central bank. All in all, we are having very active session ahead today after 2 holidays. Thank you.
Thank you, JK. And I think you summarized the first part of what's going on in the global markets well. It's mayhem in the bond street. The 10-year bond yields continue to rise, and we have been observing countries selling US bonds, including China and Saudi Arabia. The situation is somewhat similar across in Germany and Canada, where bonds are being sold. China was in the news after it cut its medium-term lending rate, followed by weaker industrial production and retail sales data, along with certain crisis-led measures, including refusal to release the youth unemployment data, as well as asking big players to not sell equities. Speaking of equities, global equities lost around 2% this week, while it seems the global trade is somewhat facing a recessionary pressure, with trade figures from various countries showing signs of pressure and trade shrinking. That's not something which has not affected India. Even Indian trade exports have been affected by this slowdown in global trade. But RBI, because of RBI's consistent selling, it has not created much of a panic in rupee. It is gradually falling against the dollar, against any haphazard moves like the Chinese yuan. Inflation data from India was also a shocker at 7.4%, which was much higher than what was being expected. So, as JK mentioned, an active session in front of us. We'll keep tracking these updates and bringing them to you. That's it from us today. Thanks for listening, and tune in tomorrow for another round of fresh updates. Thank you.